Okay, let's shift focus and divert our attention to Motown. Given that the November dispatch figures were announced yesterday, and it's been yet another blowout quarter, or rather month, coming in from Motown per se. As was the case with Escorts as well, they managed to post the best ever November sales. Clearly, it's been a bumper number, so let's try and understand and dig deeper into those numbers. Joining me right now, Bharat Madan, the Group CFO at Escorts. Bharat, hi, good morning. Good to have you on the show. How were the retail sales, Bharat, last month, and did you expect the strong momentum to sustain post-Diwali, Dhanteras as well?
Yeah, the retail has been quite strong. Actually, it's been better than wholesale numbers, I think, what we reported. But wholesale did get impacted by the supply issues and the production cost, which we had on the capacity side. But obviously, the retail was quite good. 50% growth has happened in the industry on the retail side. And I think that the momentum is, I think, continuing. If you look at the inventory levels, have been very low across the channel and the company too. So I think next few months actually will be more used to do the channel filling for the inventory. So that means the industry numbers will continue to look robust going forward too.
Sure. Wanted to understand what is the inventory scenario currently at, both at the factory as well as the dealer level?
So it's very low as of now. I think it's more like hand-to-mouth situation currently. So that's, I think, something which can also impact the retail sales volume. And within the factory, we are actually in the company we are letting on route now, which basically is a transit inventory that we are left with essentially. And with the channel also, it's less than 2 weeks inventory. So it's very low level. I've never seen these sort of levels. So I think it's a requirement to fill up the channel now going forward.
Sure. Mr. Madan, just to understand as well, going forward now, what are the kind of projections you have in place? Do you see this momentum sustain? What are the kind of numbers that you're working with now going forward for the second half?
Well, as we mentioned, since now, obviously, the channel is totally, I think, hardly left with any severe inventory level. So actually the channel selling is something which is important, which will happen. So far we've seen the industry in the first 8 months of the year has grown about 15%. So going forward, we expect the similar momentum will continue with the better wholesale and with the heavy harvest also happening, which we also expect this time. Should be record harvest. So that should also further actually pump up the demand. So we expect it should be a very good season actually in February, March too. So I think overall for the full year, we expect the industry actually will have double-digit growth now coming in. Maybe in the mid-teens to maybe even the percentage, maybe high teens to possible.
And so then are you also planning to ramp up output in that case?
Yeah, we are working on capacity expansion too. So as of now, our capacity is at 10,000 tractors per month, which we are doing. The last 4 months we've been producing at peak capacity levels and even going beyond that. So we are trying to ramp it up to level of 12,500 tractors per annum, so per month, which will be about 150,000 on the own capacity. And then we'll also have another JV capacity with Toyota, which will be coming up on stream sometime in the first quarter of next year, which will be another 30,000 units. So combined capacity should touch 180,000 tractors per annum by say August, September next year.
Mr. Madan, I just wanted to understand as well what the volumes have been for the construction segment, and when do you expect that construction equipment will start improving meaningfully?
No, we are seeing very positive traction actually in the construction equipment space too, especially the last 3 months in the festive season have been quite good for them. So we've seen actually the growth coming in year on year in that segment compared to the first 6 months. Actually, we had the big growth further to the extent of 45-50% level. So now we're seeing the recovery has started happening. So hopefully H1 actually will give some sort of growth in that segment too. So the exit will be at a better growth level. Though on a full year basis, still the volumes will be slightly negative because the first half has been completely washed out. But going forward, things are promising. So we think the growth momentum will continue in that segment too. But there also the issues will be, I think, more on the supply side because we have a common backend now, so some issues will be there on the supply side there as well. But I think as the things improve and going forward, we expect I think the numbers will start looking better in that segment as well.
Okay. And tell us a little bit more about your margins. What is the reasonable margin level that you can guide for us, factoring in the strong rural demand, the significant cost compression that the company has done? Are you confident of sustaining margins at 18% plus levels?
You mean for the tractor business, right?
Right.
Yeah, so there we expect, I think this year we should look at 79% margin, which is quite possible. Given the last quarter was quite healthy. Even now the volume advantage definitely will be there, so operating leverage will be at play. And again, this year, this quarter specifically, like QC also looking at a record quarter, and that's the volume. The first 2 months have already given us 24,000 tractors, so even the December is likely to do better. So I think overall, I think the margin story should continue. So I think maintaining 70-80% level is quite feasible even in the current situation. And if your stations start going back to the normalcy and the costs also start going up, still I think that sort of margin will be able to maintain.
To understand what's happening at the commodity costs level and whether or not you foresee any commodity related pressures by way of costs, and would you then undertake any price hikes?
So as you mentioned in our press release day before, we already taken a price hike for after the festive season. So the commodity prices have already started moving up. We're seeing the chain price have moved up on the steel also. So from September onwards, the pressure has started coming in. So the first increase we had taken now in the middle of last month, by passing on about 1.5% price increase to the market. So that is the first, I think, correction which has happened now in the surprising. So as of now, we think this should sustain for the balance of the year. So unless we see a good increase happening in the other segment of the auto sector like commercial vehicle sector, which right now are not doing as well. So then maybe the pressure will further build up on the commodity prices. But as of now, we think the current price increase should sustain till March.
Sure. Okay, Mr. Madan, good to have you on the show. And thanks as always for taking the time out. That's Escorts and Trade for you, holding up quite smartly, up about almost 1.5%, reacting to the November Motown sales numbers. For the index, we are absolutely flat, but again, it's a lively, broader market, so no causes of complaint. HPCL, ICICI Pru, IOC, Tata Motors, Nalco, these are your big performers in trade. We're going to take a very quick break on that note. When we come back, the management of BEL joins in for a special chat.